4,000 is really the new 3,000 for gold. So 4,000 is kind of the support. This is not, the end of this. Gold's going a lot higher. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. Silver has clearly broken out. It's proven that 50 isn't a ceiling anymore, especially when the dollar really starts to tank.
I'm very pleased to welcome back Peter Schiff, founder and chief strategist of Euro Pacific Asset Management, founder of Schiff Gold. We'll talk about gold. We'll talk about the economy. We'll talk about any updates, any changes of heart with Bitcoin, Peter. We'll get to that. Peter, welcome back. I saw you last time at the Bitcoin Vegas conference, so we'll end on Bitcoin and we'll loop it all back. And you were explaining why you attended a Bitcoin conference. This is a very interesting interview. Link down below. People should check that out. Let's start with gold. People have been talking about the end of the bull rally, and not just with people, guests on my show as well. Potentially end of the gold rally. If you look at the charts, Peter, it does look an awful lot like 2011 when gold peaked. Then it didn't stay there for very long. It doesn't seem to. Here, let me just show you a chart to illustrate the point and show the audience what I'm referring to here. In the past, whenever gold has peaked, it doesn't seem to have stayed at its peak for very long, meaning it doesn't really consolidate sideways and then go down. It just kind of falls. And it's even more dramatic with silver, which reached $50 an ounce for the first time since 2011, and it's only happened 3 times in history. And at each time, it stayed for a matter of days at most before it fell back down. What's going on right now with the precious metals? We can start with gold first if you want.
Yeah, well, first of all, the peak in 1980, that's when gold went from $35 to $850. So that is an enormous move. I mean, we're not even close to that, that type of move this time. And in fact, even the 2011 peak, gold started that run about 10 years earlier at around 250. So we went from 250 to 1900. And if you figure this run, we broke out at 2000 was the highs. And, we've gone maybe double from 2000. So it's not anywhere near the type of rally that we saw in the past. And even if you measure it from the low of the correction after it hit 1900, we're only about a 4x move from that low when gold pulled back to 1050. So I think even relative to those other big moves, this one is still pretty early. I think it has a ways to go. But yeah, I mean, gold had started to move up very rapidly. So it doesn't surprise me that it pulled back. I mean, it was a pretty violent pullback. We had a 6.5% decline just in one day. And of course, the biggest moves in bull markets, and that this goes with anything, not just gold, but in stocks or, it's always the downside, right? In a bull market, the biggest moves are down. Like in a bear market, the biggest moves are up. And they generally shake out the weaker players. They create a lot of fear that, it's over, time to get out. And they're usually very violent, but they end very quickly. And while a lot of people are frightened of the move, they end up missing out on the opportunity to buy. And I think that's going to be the case with this shakeout. I think gold is going to keep moving up. I think, it's probably healthy that we had a big pullback to kind of keep the speculators in check. The people who come in on leverage and use tight stops, a lot of those guys probably got flushed out in the pullback. We had a big drop in the mining stocks, far more than we did in the price of gold. In fact, a lot of mining stocks ended up losing all the gains, I think, since about 3,700 gold, even though gold is now about 4,100 and change. And there are many gold stocks that are already in bear markets, technically, that in a couple of days have dropped by 20%, as if, everything is falling apart. But we're above 4,000. I think it's interesting that the low of the pullback so far was still above 4,000. So when you're talking about we had this huge sell-off, but gold was still above 4,000. I mean, we didn't sell off from 4,000. We sold off to 4,000. And so I think it's, gold's made some good progress, but most of it has come based on central bank buying. There's very little retail investor interest. I mean, I think.
Well, just on that note, here's a chart of China's gold stock, just to illustrate your point. Is that let's assume the data is correct, Peter. Is that the main contributing factor here to this rally?
It's certainly a contributing factor. I mean, China's a big buyer, but they're not the only buyer. But the point is that that's not speculative buying. I mean, China isn't buying gold to flip it. I mean, this gold's not going to see the light of day for who knows how long. China is buying to have gold as a reserve to replace the dollar. And I think that's what a lot of other central banks are doing. They're buying gold to restore gold as, the monetary backing of their currency. And this, I think, is a major, transformation in the global monetary system. I think it's on the order of, or maybe bigger than what happened in the 1970s when we went off the gold standard. And so the world went from having the US dollar backed by gold as the reserve to just having a fiat currency as the reserve. That was a significant shift in the monetary order. But now it's not the US going off the gold standard. It's the world going off the dollar standard and returning to the gold standard. And I think that's probably even more significant, certainly for the United States, because we're about to have the rug pulled out from under us. And, we've been living off of the dollar's reserve status. We've used it as a crutch to live beyond our means. We've enjoyed lower consumer prices and lower interest rates and higher asset prices as a result of this privilege that I think we are in the process of losing. So when you point to these other moves up in gold and silver, I think they were largely driven at the peaks by speculators, by retail investors who were, jumping on the bandwagon and pushing the markets to, kind of extreme points, and then they would go down. I don't think we've even seen that yet. I think that retail investors have barely participated. In fact, if you look back at the flows from all of last year and most of this year, retail investors were selling gold ETFs. They were selling gold stock ETFs. So they sold into the rally. They weren't buying. In fact, if you talk to a lot of the, the smaller coin shops around the country, and I've seen interviews, most of the people that came in over the last few months were people that were selling their gold. They were like bringing in their jewelry to melt it down and get some cash. It wasn't a frenzy of people looking to buy gold. And the institutions, are barely involved. The pension funds, the endowments, hedge funds, I mean, they barely have any position in gold. It wasn't until just recently that you saw, more talk from, Ray Dalio although Jeff Gundlach has been talking gold for a while, but a few other people. Morgan Stanley came out in the last month. I think one of their analysts said that we should tweak the 60-40 portfolio to be 60-20-20, where you split your bonds in half and you buy gold. But I doubt they've had any opportunity to make the switch. I mean, they've just started to recognize gold's value after denying it for decades. I've been in the investment business for, over 35 years, and I was pretty much a lone voice, as a stockbroker, telling my clients that they should have an allocation to gold in their portfolio. And, when I went on major financial networks to talk about it, they generally laughed at me, or they accused me of fear mongering or just trying to sell gold. They didn't accuse a stockbroker of recommending a stock because he's just trying to sell stocks. And of course, I was both, right? I was in a stockbroker, but I also thought that people should have gold as part of their portfolios. But that was sacrilegious. But now people are starting to say, hey, wait a minute, given the fact that gold has outperformed stocks over the last 25 years, if you go back to 1999, when the Dow peaked at 45 ounces of gold, today it's worth, it was 11. I didn't do the math today, but it was, just recently down to 11. That was a 70% decline in the price of the Dow Jones measured in real money, measured in gold. And given the fact that just holding gold, in a shoebox beat the Dow. And I'm not talking about just the price. It actually beat the return because the dividend yield has been pretty low over these years. You actually did better just holding a gold coin. And so I guess, given that, I think Wall Street finally recognizes that, yes, gold has a place in your portfolio. And if that's the case, well, this rally has a long way to go because that means a lot of investors have a lot of gold they need to buy. Meanwhile, the central banks are getting started. I don't think they're nearly complete in their transformation of their reserves. They still have a lot of dollars to get rid of and a lot of gold to buy.
Before we continue with the video, let's talk about our sponsor today, Odoo. Odoo is a complete business management suite trusted by over 15 million users across the globe. Whether you're a freelancer or scaling a growing company, Odoo brings everything into one place: sales, CRM, accounting, inventory, HR, project management, and more. It's all fully centralized and integrated. Your CRM connects to your invoicing, your sales flow into your inventory, and your HR tools sync with payroll. Everything communicates in real time, reducing manual tasks and errors. And Odoo grows with your business. Start with one app for free with unlimited hosting and support. Then add more as you scale. When you're ready to go all in, access the full suite starting at just $24.90 per month. Check out the link in the description down below to try Odoo and simplify your business operations. That leads to my next question. A huge paradigm shift happening right now. Central banks accumulating gold. Depending on which source you're looking at, this chart may have slightly different numbers, but the trend is still the same. The world central banks are holding now a higher percentage of gold reserves than treasuries. According to some sources, this chart shows that they're just about to equal 25 and 25%. However, the trend is indisputable across all sources. This trend is starting to pick up around 2023. What is changing in the world right now, fundamentally, that it wasn't around or wasn't applicable maybe a couple of years ago, that is prompting all these central banks and foreign reserves to accumulate a lot more gold and dump treasuries? I mean, can it just be Trump's policies? Is it just as simple as that?
No, I don't. It's not just Trump. I mean, Trump isn't helping. In fact, on the margin, he's hurting. But I think that the trends would have continued regardless of the outcome of the last election. I think, a big catalyst, although not the cause, because it would have happened anyway. But I think when Biden sanctioned Russia, and I said this at the time, that those sanctions were sending a powerful message to the whole world to get rid of dollars and not to use the U.S. dollar and U.S. treasuries as a reserve because we could yank them out from under you whenever we want. And so that's not a good position to be in. It's like, tying a rope around your neck, throwing the other end over a tree limb and hoping the guy that catches it doesn't pull it, right? So I thought that would cause money to come out. But I think what's even more significant is a long overdue realization that the U.S. cannot possibly repay its debt, honestly, that the national debt, which is now $38 trillion, and of course, that's just the bonded debt, not with all the unfunded liabilities, but the treasuries that a lot of foreign central banks own, there's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher, right? They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates, but we're letting our creditors know that if you hold dollars or treasuries, you're going to lose. We are going to debase what you're holding. and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars and get out of treasuries. Why hold U.S. treasuries and earn a 3 or 4% yield if inflation in the U.S. is going to be higher than that? And of course, if the U.S. dollar is going to lose more than that in terms of purchasing power on an annual basis. And so rather than holding dollars and investing them in treasuries, they're going to hold gold. I mean, that's it. I mean, we've basically put them in that position. And I think what Donald Trump has done to really, sound the alarm and, give these guys, a kick in the ass as far as getting this done is, the Republicans and Trump, campaigned on fiscal responsibility, on, we've got to rein in the Biden deficits. We had all this inflation because of deficit spending under Biden and the Inflation Reduction Act. And so we need to get in there and we need to cut spending. And, they had Elon Musk. We're going to come in with Doge, the Department of Government Efficiency, and we're going to slash and burn. We're going to be like Milei in Argentina. We're going to take a chainsaw to government, right? So, these promises were made and none of them were kept. And when Trump not only signed on to the big, beautiful bill, but was one of the main reasons that it passed. He championed that bill, which not only preserved all the Biden deficit spending, but made it worse so that the deficits that Trump inherited from Biden, and, to say he inherited it, he also created a lot of it when he was president. But forgetting about that, the deficits that he, walked into when Biden gave him back the baton, now they're even worse. Now they're bigger than they were. On top of that, the credibility of the Fed, which in my mind, there was no independence. It was more of a pretense, but now they're dropping the pretense. It's pretty obvious that the Fed is political, and Donald Trump is trying to make it even more political by stacking it with, his cronies, the same way that Roosevelt stacked the Supreme Court to try to get his unconstitutional New Deal programs, approved by the court. Trump wants guys on the Fed, and he's going to have a chance to put somebody else in there to replace Powell, because Trump wants interest rates slashed. He wants the Fed to crank up the presses. So again, this is a message that, look, if the Republicans are not going to be fiscally responsible, then nobody is going to be, because we're certainly not going to get that from the Democrats. They want to spend more money. Then I think on top of all that, Trump vilified all of our trading partners by accusing them of ripping us off and exploiting us. And we're going to put all these tariffs on imports from your country. And I think he pissed off a lot of people and literally bit the hands that have been feeding us, because Trump really has it backwards. The world, we've been taking advantage of the world. We've been ripping them off because they give us real stuff and we just print money and hand it to them. And so our lives are better because we have consumer goods that we didn't produce, and all they get is paper. And what they've been doing with that is just loaning it right back to us. They buy our treasuries. They buy our mortgage-backed securities. They buy our stocks. And so they prop up our asset prices. They suppress our interest rates. So we've been living off of this, right? We've gotten low prices for consumer goods, lower interest rates on our home loans or our car loans. And we've indulged ourselves at the expense of the rest of the world. We've lived above our means because the world has been content to live beneath its means to make that possible. But I think all that is coming to an end. And I think that's what $4,000 gold is telling you. And this is not, the end of this. Gold's going a lot higher, especially when the dollar really starts to tank. And I think you're going to see that, if not by the end of this year, sometime in 2026.
It's going to start to tank on the back of more fiscal irresponsibility. Maybe gold is signaling a lot more growth, because if you've got a lot of fiscal stimulus, well, that portends economic growth, does it not?
No, I don't think gold is signaling growth. I think it's signaling inflation. Okay. And so I think you're going to see the weakness in the dollar against other fiat currencies. I mean, clearly, when gold is at 4,000 and it was at 2,000 2 years ago, the dollar's lost half of its purchasing power in terms of how much gold you can buy with your dollar. So the dollar is losing value against real money right now, but so are the pound and the euro and the yen and all these other currencies. But I do think that you're going to start to see the dollar losing a lot more value relative to its fiat counterparts, either before the end of this year or next year, and that's going to accelerate the increase in the price of gold in dollar terms. But I think it's already, giving you a forewarning that that's going to happen. I think gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%?
Well, that's
the way
simple,
the government
Peter.
measures it.
That's simple. The Fed just moves its inflation target to 3% unofficially, and then you've got more QE to be justified.
Well, but I don't think they could do that, because just moving it to 3%, once you move the goalpost once, right? Well, now you've already broken trust, because if you can move it to 3, you can move it to 4. But even moving it to 3, is a big game changer, because that means a 50% increase in annual inflation. So, what does that do to the present value of gold if inflation is going to be 50% higher from now until the end of time? But of course, they're not going to achieve 3, because if they give up 2 and they move to 3, well, then they're going to give up 3. They've already proven that their target is BS when they're above it. They don't have the monetary cojones to do what it takes to bring inflation down to 2%. Well, then why would they have it to bring it down to 3% or 4%? So I think, once they move it, they're done, which is why they probably won't. I don't know that they're officially ever going to say that they have a target of 3. I think they're going to keep a target of 2, but they're just never going to hit it. And I thought it was really ridiculous. In the last FOMC meeting, somebody actually asked Powell about about his forecast, because he pointed out, hey, 2 years ago, you predicted that in 2 years inflation would be 2%. And now it's 2 years later and it's way above 2%. And you're still predicting that 2% will have 2% inflation in 2 years. And he said, why should we believe you? What makes you more confident now than you were 2 years ago when you made the same prediction? And Powell basically said, look, we don't really know where inflation is going to be in 2 years. It's just that 2% is our target. So that's our forecast. We just assume that we're going to hit our target, but we have no idea. So in other words, they just make it up. The only reason they forecast 2% is because they want it to be 2%, not because they think it's going to be 2% or they have any reason to believe that it's going to be 2%. So they could just keep on talking 2% inflation, just to pretend that they've got that target. But, we're not going to go anywhere near it. What they may do to try to get closer to 2% is not change the target, but change the CPI. I mean, that's how the government operates, right? You change the methodology for calculating the CPI so that you get a lower number. That's what they did with the Boskin Commission. That's why the whole CPI is irrelevant today, because it's been rigged by the government to have a low number.
One possible explanation for why the markets have been doing so well is because the Trump administration is openly encouraging government investments into some private sector companies. You even tweeted about this morning. America's turning more socialistic, you said, centrally planned economy. Trump wants to plan to invest taxpayer money in several quantum computing companies. Maybe you think Trump is so smart that he's the one guy who can make socialism work, but how would you feel if AOC is the next president who gets to decide how to allocate capital in America? By the way, this is referring to a Wall Street Journal article that is quoting people familiar with the matter. Since that article came out, CNBC ran an article saying that the Commerce Department is denying such claims. So who knows what's going on? But all right, so the official stance of the government is that they're denying this is happening. We'll see if they actually carry through with it. But what is the broader trend here that you're trying to tell us about in this tweet? Yeah.
Well, Trump has already made investments in public companies. So it's already happened. So it's not like this would be brand new. This would just be more of what he's already done. But first of all, there's nothing in the U.S. Constitution that authorizes the U.S. government to invest money in companies. It's just not a legitimate function of the federal government, let alone the president of the United States, to just decide that the U.S. government is going to invest in any company.
Well, hold on. Isn't that what a lot of countries around the world already do? They take stakes in companies they nationalize some companies. Or go ahead.
Yeah, well, I'm not familiar with their constitutions. I don't know what the law says in those countries. But just because those countries do something wrong doesn't mean we should do it too, right? Mm-hmm. I mean, there's a lot of political pressure for governments to get involved, normally by the companies that benefit. But what people often overlook is, to the extent that the government allocates money into particular companies, right? Well, that means money is being allocated away from other companies. So the government is deciding where capital should be invested as opposed to the free market. And that's never a good thing. Just like we don't want the government to decide prices. We want the free market to decide what prices should be, because those prices send important signals to producers and consumers regarding resources and how to allocate them and what to produce and what not to produce. The same thing with capital. We want investors investing money in ventures that they believe are going to be profitable, right? Because you need investment to be guided by a profit motive, so that investments are directed to areas that may best produce results that will improve our standard of living, that will lead to production of goods and services that we value and that increase our life. But when the government is allocating capital, it's not doing it for those reasons, because it's not allocating your own money. I mean, when Donald Trump decides to put taxpayer money into an investment, it doesn't cost him anything if it goes sour, right? Like, remember with Solyndra, right? It's like, if you're investing somebody else's money and you have no skin in the game, what the hell do you care? So now you start to be guided by politics, right? Which companies is the president investing in? What is he getting under the table to allocate taxpayer money to these investments? What is his family going to benefit? How are his personal business interests? What is he getting? What is the quid pro quo that we don't know about that is guiding this? Or is he doing it for campaign donations or votes? Or what? It's not real market forces. It's political forces that are behind the allocations. And then, of course, once the government has a stake in a business, right, well, I mean, it's like, it'd be like in a football game, the referee is a member of one of the teams. I mean, he's not going to call everything fair when, he wants his team to win. So if the government is invested in the company, well, it's going to naturally want that company to do better than its competitors. So it's going to, rig the field and it's going to, pass, maybe some laws or regulations that might advantage the company that it is invested in at the expense of the companies that it hasn't invested in. So, this is not what government is supposed to do. Certainly not in the United States, but it shouldn't do it anywhere. Government needs to just stay out. Government's there just to protect our rights, not to invest our money.
I just want to get rich off the market, says a lot of people. Okay, so I don't care what the government's doing, but let's just follow this trend. If the government is investing in tech companies, whether it's constitutional or not, we can debate that. Let's just follow that lead and invest in tech companies. Evaluate that logic, please.
Yeah, well, again, that may be causing a misallocation of resources. People want to invest where the government is putting money because they think that they'll do better because the government is propping up those stocks. And
Sure.
so if people decide to invest money where the government is misdirecting it, they're taking those funds away from other areas that they might have invested in, and that maybe the free market would have allocated capital someplace else. But because of the government, those other businesses are not getting that capital. That capital is being sucked away and put into, quantum computing or AI or wherever the government decides that it wants to go. But maybe the free market, which is going to be a better allocator of capital. I mean, there is no precedent in human history for governments doing a better job of allocating capital than a free market. It's just, there is no example of that. And it's not going to change. We're not going to be the first example of socialism being better than capitalism. And so, it's a mistake. And I'm sure a lot of investors are going to do this. Look at all the resources that have been misdirected to the crypto industry. What a gigantic waste, because the president has decided to make crypto a priority, to have pretty much a crypto cabinet with a crypto czar, and his family has decided to make crypto the family business. I mean, forget about real estate or whatever else they're doing. Their main industry now is crypto and Bitcoin and whatever. And so he's trying to channel all kinds of resources into an industry that he's now, betting on personally. But if you listen to how the crypto industry tries to, to promote itself now, it's basically saying, hey, the government has embraced it. The government has legitimized it. The government is now friendly to crypto. The government's going to have a Bitcoin strategic reserve. And so because of the government promoting crypto, you should invest in it. You should put money in these companies, right? So people are doing that because the government has put its seal of approval on this particular industry, which could end up being a disaster. And I think it will be. I think the whole thing is a giant Ponzi scheme. I think we are squandering all these resources that could have been put to productive use. I mean, the president makes a big deal, and rightly so, out of the fact that our manufacturing is gone and our industrial base is gone. And he thinks we're going to get it back with tariffs. Well, the tariffs are going to backfire and make it worse. But what's also going to make it worse is misdirecting resources that could have gone to building factories to creating meme coins. What the hell are they going to produce? I mean, if we spend all this resources on crypto, then we have even bigger trade deficits because the crypto industry produces nothing. Right? So the things that we need to buy, then we have to import.
When you think about it, it's a smart way to increase the money supply, isn't it? You produce meme coins out of thin air. They go up in value. Presumably the people who buy them get richer, and the Fed doesn't have to print more money. It's kind of clever.
Well, they only get richer if they sell them. And
right.
They're getting richer because somebody else is dumb enough to buy them. Now, the one way that it does lead to more inflation is to the extent that they can leverage them. People can go out, you can take the crypto assets and jack up the price, and then you can find some bank that will loan you money on that crypto collateral, right? So you're manufacturing collateral out of thin air, and then you're borrowing against it. So that creates inflation right there. But nobody would be dumb enough to lend you money on that if it wasn't for the government support,
All right, comment down below if you would buy a Trump meme coin if he makes a new one. I want to draw your attention to this. Well, I'll play 30 seconds of this. It's a quote from Anton Kobiakov. He's one of Putin's advisors. This is circulating on social media all throughout September. I haven't had a chance to ask you about it because I haven't had you on the show since September, but take a listen.
Америка прямо сейчас пытается поменять правила на рынке золота и криптовалют. Вспомните, какой у них долг. $35 триллионов. В общем-то, это два альтернативных валютному сегменту мировых рынка. Действия Вашингтона в этом направлении отчетливо демонстрируют одну из главных американских задач. Они очень хотят решить проблему снижения доверия к доллару. США, как это было и в 30-е, и в 70-е годы, будут решать свои финансовые проблемы за счет всего мира, загоняя всех куда? В криптовалютное облако. Со временем, когда часть госдолга США будет размещена в стейблкоинах, США обесценит этот долг. Еще раз простыми словами, у них сейчас валютный 35-триллионный долг, они его загоняют в крипту, в облако, обесценивают и начинают с нуля. Это для тех, кто очень любит заниматься криптой.
Basically, he's saying the U.S. is now trying to rewrite the rules of the gold and cryptocurrency markets. Remember the size of the debt, 35 trillion. Actually, it's 38 trillion as of today, just reported. These two sectors, crypto and gold, are essentially alternatives to the traditional global currency system. Washington's actions in this area clearly highlights one of its main goals to urgently address the declining trust in the dollar. As in the 1930s and the 70s, the U.S. plans to solve its financial problems at the world's expense, and this time by pushing everyone into the crypto cloud. So he's basically accusing the U.S. of issuing stablecoins to devalue, to hide its debt and shove its debt into the cloud. So I'll let you comment on that. Maybe you've seen this already.
Well, I don't know. Well, first of all, I don't think the Bitcoin is a legitimate alternative to the dollar the way gold is. I think that's how Bitcoin is marketed and promoted by the industry, that it is an alternative, but I don't think it is. I think it's, very different than gold. In fact, it's probably the anti-gold. And if anything, it's more negatively than positively correlated with gold. I think the reason that Bitcoin has gone up is because tech stocks have gone up, and you have a positive correlation there between, high risk speculative assets, and that's where Bitcoin is. Gold has not gone up because it's a speculative asset. It's gone up as a safe haven, as a store of value, as a legitimate alternative to the U.S. dollar. So they're moving sometimes in the same direction, but for different reasons. But I don't think that the stablecoin industry is really going to do much for the U.S. ability to finance its debts, because to the extent that people decide to keep more money in U.S. dollar stablecoins, they're going to take that money out of money markets, for example. And so that's going to reduce the demand for U.S. treasuries from money markets and just, shift it to stable coins. But I really don't see a lot of demand for stable coins. I think most people today that use them, they're crypto traders. And so they're just parking money there between their trades. I don't see a lot of demand for, the general public to hold U.S. dollar stable coins if they're not using them to trade Bitcoin or Ethereum or any of these things, because you don't get any interest on a stable coin. If I keep my money in a money market, I'm getting like 4% interest. And I've got plenty of liquidity. I can have a checkbook. I can have a debit card. I can use my money market to fund transactions through, like a PayPal or Venmo or, So, why would you give up your interest on your money just to hold a stable coin and earn no interest? I mean, it's a great deal for the stable coin issuers because they take everybody's money and they buy the treasuries and they keep all of the yield for themselves and give none of it to the stable coin owner.
I want to get your reaction to Scott Bessent's comment on this. We haven't spoken about this, you and I, because this was issued in July. We last spoke in May. The Genius Act passed during the summertime, as you know. It's a new law that mandates that new government issued stablecoins have to be backed 1-to-1 to the U.S. dollar. This is what Scott Bessent had to say. Stablecoins represent a revolution in digital finance. The dollar now has an internet-native payment rail that is fast, frictionless, and free of middlemen. This groundbreaking technology will buttress the dollar's status as a global reserve currency, expand access to the dollar economy for billions across the globe, and lead to a surge in demand for U.S. treasuries, which now back stablecoins. This goes back to your earlier discussion about the U.S. dollar losing status. Perhaps this, according to Bessent at least, is going to, in his words, buttress demand for U.S. treasuries. It'll save the U.S. dollar, Peter.
Yeah. Yeah, look, I think that's all a bunch of BS. I mean, that's hype. That's designed to promote crypto and Bitcoin so that Trump's, insiders, his friends, his campaign donors can hype up the market that they're selling into. So I think there's no connection in reality there. I don't see a huge demand for U.S. dollar stable coins. First of all, they can issue stable coins denominated in euros, denominated in Swiss francs. And I mean, anybody could do this all around the world. And so I don't know why people would say, well, I want to have a stable coin that's stable to the dollar, especially when we have all this debt and we're creating all this inflation. So to the extent that people want a stable coin, let's say I'm living in Europe, why would I want it to be pegged to the dollar? I mean, I might pick the euro or, the Swiss franc or something else. And but I think ideally and ironically, the concept of having a token backed by something, the best thing to back a token would be gold. I mean, so to me, a gold-backed token, a tokenized gold, right, which would be a token that's stable to the price of gold, that could be used as a medium of exchange, as a unit of account, as a store of value. I mean, people could make payments and receive payments in gold just as easily as US dollars. I think that's a big threat to the dollar, because one of the things that the dollar had over gold was that it was more convenient to use dollars than it was to use gold. It's easier for me to go into a Starbucks and buy a cup of coffee with dollars than with gold. But with tokenized gold or, gold stable coins, it's just as easy to buy coffee in dollars. But more importantly, it's just as easy for the coffee merchant to be paid gold for his coffee. And, that I think that's ultimately what's going to drive the payments in the future, is going to be the preference of the seller, the provider of goods and services. How do they prefer to be paid? Do they want to be paid in a rapidly depreciating fiat currency, or do they want to be paid in real money that holds its value? Because
we don't have that option though, right? I can't, accept payment in gold right now. I mean,
but
I can make a private contract.
If there was a gold, like stable coins, right?
Right. Okay.
A store could say, yes, we accept payment in this coin. You can pay us in this token. Right?
Sure.
And then they could get paid in gold. They could give you maybe even a little discount if you pay in gold.
Sure.
Because they prefer to receive gold, because gold will maintain its value. See, what's going to happen, I think, with a lot of companies as inflation really starts to accelerate. Let's say I've got a business and prices are rising 10% a month. If I sell you something and I take dollars, now I've got to replace my inventory. Well, what if the inventory is getting so expensive that it costs me more to replace what I just sold you? So what might have to happen is that in order to maintain some stability, businesses will move away from depreciating fiat currencies and just work with gold, because they know, okay, if I accept gold for my products, when I have to restock, I have gold to pay, because prices won't be going up in gold. They're going up in dollars, but they may be stable or going down in gold. So that's the currency I'd rather get paid in, would be gold. And that gold isn't currency. Gold is actual money.
Yeah, we have a few minutes left, Peter. I want to get your reaction to one final piece of story. This is breaking on Wall Street this week. Regional banks reacting to bad loans. Zions Bank, Western Alliance Bank, investment firm Jefferies surprised investors by disclosing various bad investments in their books. Reaction from Jamie Dimon, chief of Morgan Stanley. He said, and I quote, "When you see one cockroach, there may be possibly more." And I think this article from the Los Angeles Times closes with, investors are wondering if there might be bad news to come. In other words, more cockroaches. How would you respond to this? What is going on right now?
Well, look, Jamie Dimon ought to know, because they're his cockroaches, right? But look, obviously we have credit excesses. We've had a huge credit bubble fueled by the Fed and government backed banks and loans. In fact, the main reason that the Fed stopped hiking rates the first time wasn't because they won the battle against inflation, but because the collateral damage was causing banks to fail. You got Silicon Valley Bank failed. You got Signature Bank. There was another one. And that was it. The Fed basically stopped hiking rates because the rates were so high, and they weren't even that high, but the banks started to fail. And more banks would have failed had the Fed kept hiking. So they stopped. And I think one of the main reasons they're cutting rates is because more banks would fail if the Fed left rates where they are. And that's because I think all of our banks are fundamentally insolvent. And they're insolvent because of Fed policy. They've kept interest rates so low for so long that if the Fed were to normalize rates, and they're not normal now, they're still too low, despite all the talk that rates are too high and they need to come down, $4,000 gold is proof that rates are too low and need to go up. You know, Alan Greenspan, when he was Fed chairman, he told the Senate or the House that if gold got to 400, that meant that monetary policy was too easy. That was his way of keeping the U.S. on a gold standard, was to watch the price of gold as an indicator of whether or not he had monetary policy right. And he said, if gold gets to 400, that's telling me that I'm too loose. Well, we're 10 times that price now. So if $400 gold was saying the Fed was too loose, what is $4,000 gold saying? So yes, you know, we have all kinds of bad loans, including the U.S. government, right? The U.S. government has borrowed much more money than it can ever repay. It has borrowed more money than it can service. But the only reason we have $38 trillion in debt is because interest rates have been kept so low for so long. If interest rates were much higher, the government couldn't have borrowed all this money. We couldn't have afforded it. So we would have been forced to cut government spending years ago, decades ago, if it had not been enabled by the Fed. And so, yes, there's cockroaches all over the place, not just in these small banks, everywhere, including the White House, you know, Congress, the Federal Reserve. So they're all gonna come out.
One more sentence here. There were other signs of distress. Federal Reserve data shows that banks tapped the central bank's overnight repo facilities, an action not taken since COVID. This facility allows banks to convert highly liquid securities, such as bonds and treasuries, into cash to help fund their short-term cash shortfalls. The bottom line is here is, Peter, are you concerned about another regional banking crisis right now, or is this just a case of a few banks mismanaging their loan books?
Well, I'm more concerned about a U.S. dollar and sovereign debt crisis, because I think that's going to be the consequence of the Fed bailing out all these banks and preventing that. You know, the Fed does these stress tests every year, and I always point out that the stress tests are all BS, because they don't stress test for stagflation. They don't have any scenario in which they test how a bank would perform with stagflation. So if we had a recession with rising inflation and rising interest rates, they don't test any banks for that. And I think that's because they know they would all fail. And so they don't even want to run a test if they already know that no one's going to pass. But that is the environment that we're in, and it's going to get a lot worse. And I think the only way that we're not going to see widespread failure in the banking system is if we have massive money printing. And so that's going to ultimately cause a dollar and sovereign debt crisis. And again, that is what gold is telling you. Gold is the monetary canary in the coal mine. Gold is shooting up now for a reason. And you know, to me, it's very much like the collapse of subprime in 2007, because I had been forecasting subprime to collapse for years before it did. But I forecast that as part of a broader banking crisis, financial crisis, that I knew would follow the collapse of the subprime market, which would ultimately take down the mortgage market and the banking system and Freddie and Fannie. And I've been talking about that and warning about that. I wrote about it. But when the subprime market blew up in 2007, the mainstream dismissed it as an isolated event. Even the Federal Reserve said, don't worry, it's contained. And I was out there saying, no, it's not. It's the tip of this huge iceberg. Just wait. And of course, we had the crisis the following year in 2008. Well, to me, I've been warning about a big move up in the price of gold as a foreshadowing a dollar crisis and a sovereign debt crisis, and now it's happening. And just like the mainstream dismissed the warning from subprime, they're dismissing the warning from gold. But I think gold is just indicating that a much bigger crisis is coming. And I've even heard people say that we don't have to worry about the price of gold because the dollar's not falling, because the bond market isn't falling. And so therefore, gold's rise is not reflective of a loss of confidence in the dollar or the bond market. And my response to that is just wait. Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. You're too late to diffuse the crisis, but you're also too late to prepare for it financially. That's why I keep reiterating with my clients, look, you got to buy gold, you got to buy silver, hey, you got to dip now to 4,100, or I think 4,000 is really the new 3,000 for gold. So 4,000 is kind of the support. Doesn't mean we can't go below it, but I think any dip below 4,000 will be short-lived. Silver got up to 54 and change, so it took out the 50 double top. We're back below 50 now. I mean, silver is a lot more volatile. You don't have the central bank buying to stabilize it like you do in gold. But look, I think silver has clearly broken out. It's proven that 50 isn't a ceiling anymore. Soon it's going to be the floor. People should be buying silver. I think it's very cheap. And people should be getting out of U.S. assets. I think the U.S. stock market, which has been really in a massive bear market for 25 years, I think that bear market is going to accelerate. But finally, after many, many years, foreign markets are smoking U.S. markets. I think the S&P is up maybe 13, 14% this year. I've got a foreign dividend payer fund that's up almost 50% this year. This isn't my gold fund. This is just my defensive dividend paying stock fund. But so foreign markets are finally way outperforming the U.S. And I think that trend is going to continue. It's not just central bankers who are getting out of dollars into gold. It's foreign investors who are going to be getting out of U.S. investments and reinvesting domestically. That's going to be followed by Americans diversifying internationally. So all these flows are going to be reversed. All the money that was coming into the U.S. capital markets is going to leave and go into these foreign markets. So people should, contact my firm, Euro Pacific Asset Management, because our strategies are specifically designed for this reallocation of capital. And the phenomenal returns that we've had so far in 2025, I think, are just the beginning of at least a decade of major outperformance. So you can invest directly with us, or I have 5 mutual funds that people can buy anywhere, and they can get information on my funds at my website at europac.com.
We'll put the links below so you can follow Peter's work there. And congrats on your gold calls. You've been, sounding the alarm bell on gold, and you've been right all year. So congrats on that. What are you thankful for? Thanksgiving is coming up. Let's end here. We've got 1 month. Yeah, 1 month to American Thanksgiving. What are you most thankful for this year, Peter?
Well, I mean, I still have my health. Sure. I live in a wonderful community. I've got some great kids and a wife. So, I'm 62. And so, I guess the health and the fact I have a good quality of life is probably what I'd be most thankful for. And yeah, I've done well. And I think I pretty much have the money at this point and the resources to live out my life comfortably and do the things that I want to do. But I'm still trying to make a more meaningful impact on the direction that the country is in. I love the country, at least what it used to be and what it stood for, and the sacrifices that were made decades before I was born to preserve the freedoms that we not only take for granted right now, but that we are happily giving up.
Yeah.
And so I think I still have enough time left to try to make a positive difference. And who knows, with AI, you never know. Maybe 62 isn't that old anymore. We'll see. Maybe they'll.
All right. Well, only 62
they'll be
years,
able to turn back the clock.
Well, we're thankful for you sharing your thoughts and giving us your time. So please do follow Peter. Links down below. Thank you, Peter. We'll speak again soon. Take care for now.
All right. Take care.
Yeah. Thank you for watching. Don't forget to like and subscribe.